Hey everybody, this is Ashley Page with a 5-Plan Economic Moment. We're delighted you joined us today. Our topic today is exactly a decade since the financial crisis. What are the 5 major changes in the economy and markets that appear permanent? If you go back and look at it, in September, a decade ago, 2008, this was the very month that the match was struck on what ultimately became the financial crisis. And if you remember, that was the failure of Lehman Brothers and Barclays coming in and attempting to bail them out. That's really where it started. That was September 10 years ago. So a lot of times when you have a major economic crisis event like we had in 2008, you will have blips on the radar screen of some things that will happen for a while, good and bad, and then kind of go away. If you look at it and what's important to us in markets going forward and how it impacts your money, there are really 5 things that have happened as permanent changes since the 2008 financial crisis, and let me tell you what they are. Number 1, the Federal Reserve is much more actively involved in the economy than they used to be. You remember quantitative easing. Part of what the financial crisis caused was a liquidity crisis, so our Federal Reserve was able to hit that very quickly with quantitative easing. So now we've created, going forward, a Federal Reserve that's much more active than they used to be. That's point number 1. Point number 2 is that the leverage in financial firms that caused a lot of the problem to happen at such a broad base and so quickly, a lot of sort of the radioactive or more destructive leverage we don't have now. Financial firms are much less leveraged. That's whether it's a large insurer, large investment banking firm, large commercial bank, that leverage being less and then building their balance sheet really more on earnings, that is a much safer financial system. So having less leverage is safer. That's number 2. Number 3, financial transactions cross-border, for example, between us and Europe or Europe and back. The ability for contagion to spread like a financial crisis that we had in 2008, it's much more checked now with rules and regulations. It would be much harder for a financial contagion like we saw to, say, move and migrate from the U.S. to Europe or Europe and back. In 2008, it was much easier for that to happen. Now the command and control we have over that part is much better. That's number 3. The 2 most important are the last one. Number 4, the housing market, where all this sort of started, has changed forever in the United States. The way we underwrite mortgages are different, who offers those are different, the underwriting criteria for those and who can qualify is different. That is a fundamental change. It used to be that people who provided mortgages, we had a much more broad base of client that they would serve. That client base now is narrower. Banks used to do it as a volume business. They don't anymore. They're doing it more for select and wealthier clients. That's made in a lot of ways both the housing market and the construction market for new home builders much smaller, stronger but smaller. So we've talked on prior vlogs here about there's a major impact. So that has been a large change that will be permanent. The most important large change that happened with the financial crisis that has occurred through those 10 years and going forward is the financial crisis in 2008 was much like the Great Depression in that it changed the paradigm of how Americans and international markets too evaluated risk and price risk. That really is the major change. How you price risk and how you take risk. If you look at it across the board as Americans, we are taking much less risk macroeconomically. Businesses are taking less risk. Good example of that is up until this last year with a lot of the tax improvements, we didn't have a major line of capital expenditures by business much at all. We had a little bit, but not much. What were they mostly doing? Buying their own shares back. So they weren't investing in themselves as much after 2008. Fortunately, that's begun to change some this year. The second thing is individual household. We just talked about housing. Most Americans, their largest investment is their home. So if you change the dynamics of home pricing, home building, home purchasing, that's what also slowed down the personal side. So both personal investing and how risk was taken, corporate and how risk was taken, people just take less risk now and they price it differently. So that's a 5-plan economic moment. We thought you would be interested in how that last 10 years has looked since a major event. If you have any more questions about that and want to talk further, please feel free to call us or get in touch with us on Facebook, LinkedIn, or Twitter. Thanks.